Good afternoon, fellow traders. Thanks for having me. It's my honor to join the Investor Inspiration Online Conference today. Time is short, but in the next 40 minutes, I promise to give you as much education about these high-odd probability trades as possible. Renee was kind enough to introduce me, so we'll jump right here to what we're going to try to cover in the next 40 minutes. I'm going to give you a very simple crash course on how to read charts, price patterns, and what we look for in putting on these high probability option trades. The magic's going to be alignment of the micro time frame with the bigger time frame. What is awesome about trading options is when Greg and I used to just provide stock picks, it is often extremely hard to find the high quality setups for a stock trade. Because as you know, when you buy a stock, it's single dimensional. For every penny up or down, whatever your directional trade, you profit or lose accordingly. Trading options, however, with some of the strategies I'm going to show you today with option pricing, time decay, etc., it gives you an edge, if you will. It's easier to trade than the underlying stocks because of these characteristics. I'm going to show you some simple covered call strategies. I'm going to show you briefly how to generate a weekly or monthly paycheck by writing credit spreads. I'm going to show you how to obtain quality positions at a discount, even though the media would love for you to believe that they're dangerous by selling puts. We all know the disclaimer in trading. It's our view that we are taking high probability, high reward to risk trades, but every time you engage in the market or make any investment in real estate and opening up a shop, you are risking capital to try to make a rate of return. But that obviously involves risk. Some trades are going to go against you. That's normal, and it's the cost of business. But you will see that everything we do has very high odds. Let's jump right into an overview of technical analysis, which applies obviously both to trading anything that you can chart, stocks, options, commodities. We obviously are focused on options today. Now, I'm sure you've seen many programs in the past. They're trying to sell you their newest and greatest stock gizmo that will magically detect direction and when stocks are going to reverse on a dime, etc. We are not here today to sell you any of that. Our approach to chart analysis is extremely objective and simple. So you will never see charts of ours that look like this. It's confusing. You can tweak whatever parameter you want to make it line up with your prediction. There are only 7 possible things that a stock can do. It's that simple. They go up, higher highs, higher lows, down, the opposite, or sideways, relatively equal highs and lows. Then you have a downward trend break where you don't have higher highs and higher lows anymore and you've taken out a prior low. That's when we want to initiate bearish strategies. The next one, uptrend break, you had a downtrend, it went sideways, now it's moving up. I'm going to show you how we deploy different option strategies on as many of those combinations as I can today. This is a picture of how we align the macro, the major move of a stock with its minor moves. So let's hypothetically say the macro stage 2 is a weekly chart. We then want to use the daily chart, we'll refer to as the minor stage, for the pullbacks to support, to initiate bullish option strategies. So depending on how bullish you are will determine which option bucket that you want to deploy. Here it's shown on what we call the basic stock market atom. This again shows the only possible stock market moves in existence. in other words, it's showing those 7 stick figures on the prior slide in just this graphical form. Let me shut this off. And this applies to any time frame. This bell curve, stage 1, 2, 3, 4, can be on a 5-minute chart, hourly chart, daily chart, weekly, monthly. So whatever time frame matches your trading comfort zone or horizon, if you will. If you're a long-term investor, you might focus on monthly, weekly, and daily. If you're an active swing trader and selling these credit spreads for weekly income, you might focus on the hourly and daily and weekly charts to get more active alerts. So let's just run through this. Stage 2 is circled right here. That's our breakout to a new uptrend, one of the stock market events. In that category, we want to institute bullish option strategies. That's going to be buying in-the-money calls. It's going to be bull call spreads, bullish diagonals. Stage 4 is the opposite. That was after a stage 3 sideways wide and whippy consolidation. It breaks down to a new downtrend. I don't care what the news is. I don't care what the fundamentals are. If I have this picture, then I am deploying bearish option strategies. It's that simple. So I'm buying puts, I'm buying put spreads, I'm selling out of the money call spreads, bearish diagonals. We're going to cover just a few of these today, obviously, because of the time constraints. Stage 1 at the bottom is what we refer to as the ambivalence stage of that stock, of that time frame, and it typically occurs after the stage 4 downtrend. Investors are beat up. They seem to be complacent. They seem to be ambivalent. They don't care about the market. That's when we're looking to deploy both call spreads at resistance at the top of the sideways range, and we want to short put spreads on support. If it's range bound, I'm going to show you a strategy where you can do both, and then you just leg out of the, if it breaks up or down, you leg out of the losing one. Stage 3 is the same as stage 1 in terms of the sideways consolidation. I mentioned it's typically a little choppier because it's typically after a lot of buying frenzy, which for you active traders has recently been the market after the Trump rally and robust rally afterwards. That was a brand new stage 2 where our subscribers, we gave them numerous bullish plays in there. And then it went sideways and consolidated for a few months. That was a stage 3. Does that guarantee that the next stage is 4, downtrend? No, it just means that it's a possible stage 3. It's either consolidating to move higher, which it did last week, or it's ready for a breakdown. So all during stage 3, we were deploying both bullish and bearish option strategies, primarily the credit spreads, bringing in weekly and monthly income. And now that it broke out, we were deploying bullish option strategies. We're, again, long banks. We're long call options on the spiders, SPY. And with the market internals getting a little overbought now, we're either looking to take profits or sell calls around them to lower cost basis. We approach the markets in trading options fairly simply. Once we have one of these patterns, one of the 7 stock market events, we put them into 2 buckets. Is it a directional play, stage 2 or 4, or am I just looking for short-term turning points where I'm primarily going to focus on selling the credit spreads and bringing in income where we win almost 90% of the time, and all we're doing is calling a short-term top or bottom. You can't do that with trading stocks. Stock, you have to pick a direction or you lose. That's one of the awesome benefits of trading options, which you'll see a couple examples here coming up. We win 3 out of 4 directions. Now, MasterTrader obviously has Greg Capra, the pristine founder. I've known and worked with him for over 20 years. He's the master of technical analysis. He has a number of equity training seminars to teach you how to read charts like a pro. I'm the chief option strategist, so I focus on the option strategies around those patterns, and that is what our unique combination offers. High probability option trades around compelling patterns. I got to go through a few basic definitions here for those of you new to option trading. Try to make it quick and get into some of the exciting examples. This is just some option tools. You got your quote, you got a level 2, you got a risk graph, you got volatility there, and what the heck is going on. Hopefully in the next few minutes I'm just going to demystify some of that. We have a 9 or 10 module option series that will explain all that in detail. But again, I'm not here to upsell you today. I'm here to give you incredible value in the time allotted. I just wanted to show you how many people, investors, they rightfully focus on trying to buy dividend stocks because they want to make a yield. They want the stock to go up, they want dividends, and that's their return. However, many people erroneously just focus on the dividend yield, which can get cut, like many of them got slaughtered last year with the energy crisis in that sector. So they say, oh, look, I am supposed to make 8% yield on the stock, but then the stock can get cut in half. I'm going to show you how selling puts and credit spreads is in our view, is a superior way to generate that monthly yield without that risk of just chasing high dividend yield stocks. Quick definitions here. What is an option? It can be an option on buying a house in everyday life, but what it is it gives you the right to buy or sell something during a specific time for a specific price. That's what an option is. That's what we're trading. You can buy them, you can sell them, you can do spreads, and as I just reviewed, they can be deployed in all 7 stock market movements. Call buyers. Remember, that was our stage 2 uptrend. We have the right to buy the stock. So whatever you're bullish on, I mentioned we're long calls on the spiders. We have the right to buy spiders at an agreed upon price, whatever the strike price was, on or before the expiration date. I think we did the March, and we did the in the monies, which I'll explain on the next slide. Call sellers have the obligation to deliver to that. They take in premium, the amount of money you buy with the call option, the extrinsic value goes into their pocket as pure profit, and all they're giving up is the obligation to sell at the agreed upon strike price. Put buyers have the right to sell, not to buy, so that's a bear strategy in a downtrend. Put sellers, that's going to be our secret sauce for trying to buy quality stocks at wholesale or a discount, if you will. I'm putting money in my pocket today, and one of 2 things are going to happen. I keep the money as pure profit, or I'm obligated to buy a quality stock under retail price. I have a few examples coming up. So the put sellers, as I say here, the cash is in your pocket, obligation to deliver, like insurance companies. When every one of us buys car or house insurance every year, that's exactly what we're doing. We're buying a put option, so to speak. I'm paying a premium to the insurance company. They have an obligation to deliver the face value of my policy if my asset is destroyed. Option buyers again. So the spiders right now, I'm looking at my chart, they're trading at $233. The call option that we recommended to our subscribers on this breakout last Friday, I have to go look at it. They're all in our open trades sheet, but we controlled this asset that at the time was $230 with $5 or $6 a share. So we're still getting virtually the same upside profit by buying this call option as you laying out $230 per share. Plus, we have limited risk. Whenever you buy an option, your max loss is whatever you paid for it. If you buy a stock, your max loss is $230 a share. Definition here, so you're ready to buy an option. You go look at the option quotes, and there's going to be a bid and an ask. Let's say you buy it at $3. That's your total premium that you're paying. Now there's only two components for simplicity of what makes up that total premium. Is there any intrinsic value? So if you're controlling so the spiders here, 233. If I buy a $230 call option, that has $3 of intrinsic value. Why? Because I'm controlling a $233 asset that has immediate value if I exercise it. Everything above the intrinsic value is time value. And you'll see how when you buy options, time value is your enemy. When you sell options, time value is your best friend because that's your daily paycheck. And you should win over 3 out of 4 direct market directions. Showing you volatility here of the overall market. This is the VIX, which measures market volatility. When risk is rising, volatility rises. When volatility rises, option premiums spike. So for the option sellers, that is an awesome opportunity to go look at whatever you're interested in trading, whether it's the SPY, a Fortune 100 stock that you like the pattern on, and you sell out of the money puts. Because when people are scared, the premiums rise drastically, which increases your paycheck. Last definition here before we look at some examples, theta. So that extrinsic value that the option buyer is having, that's part of the option price, is like a melting ice cube. So in order for the option buyer to recoup his or her investment and get rewarded for that option purchase, the asset has to move. If it doesn't move, that daily going sideways is called theta, or time decay. So the definition of theta is it's the rate at which options lose their value each day. You flip that on its head, and that is the best friend to the option seller. We make money on the time decay. We make the full money as long as it doesn't go under the strike price that we agreed to. Last bullet, time decay expires rapidly into expiration, which is the last 45 days, even more so in the last 2 weeks, which is why MasterTrader specializes in selling credit spreads a few days. You know, we do them 1, 2, 3 days, all the way up to 45 days. That's the sweet spot. These covered calls, these are just the patterns that you would be looking for to either sell call options, sell bearish credit spreads. Go back to our stock market atom. So that could be on stage 1 or stage 3. But if it's genuinely a stage 1, you're anticipating a breakout, so we prefer only selling these call spreads in stage 3. But if you own a long-term stock, Amazon, everybody loves Amazon, it can be in your retirement account. Whenever momentum slows, and there's different flavors of that as I showed you on the last slide, but if you see any one of those patterns on one of your long-term holdings, sell an out-of-the-money call, and what that does is it routinely lowers your cost basis. So you can look at the math on this. And by the way, I'll be happy to email this presentation to whoever would like it. I'll go over that on the last slide so you can see the actual math later. But the out-of-the-money calls here, if you own Amazon and it was trading at 840, the 845 calls were $32.30. That's almost 4% additional return on investment that you would make whether the stock goes up, down, or sideways. I mean, if the stock goes down, that's obviously yours, but this $32 is yours to keep. Another long-term favorite here, Johnson & Johnson. I'm just marking off many examples here where it would be ideal to sell covered calls to bring in additional income. Now let's talk about not only selling puts for a weekly or monthly paycheck, but we're doing it to obtain quality stocks that you want to own at a discount. These are the reverse of the patterns that we sold the call spreads on. These are all bullish. Every single one of these pictures are bullish. Greg Capper teaches them in detail in his equity training classes. But how bullish the overall pattern would dictate how bullish of option strategy we deployed. Now let's review what selling a naked put is. The media has everybody brainwashed that selling naked puts is risky, risky, risky. Don't do it, and everybody believes it because they aren't taking this 45-minute webinar today. Intelligently selling naked puts is the opposite of risky. It has the same risk to reward characteristics of a covered call, which are permitted in your IRA account as being the least risky by the SEC and the financial media. Well, selling naked puts is the same thing, but you only have one transaction instead of two. If you sell a put, what is going on? You're putting money in your pocket to the how much money? It's the premium that you're selling times the number of contracts you sold. One contract equals 100 shares. 10 contracts represents 1,000 shares. I have a few examples coming up, but the money is in your pocket to keep. Does that mean you have no risk the second you put it on? No, it does not mean that. Why? Because in exchange for that money in your pocket, you've agreed to buy the stock at the agreed upon strike price on or before the expiration date of that option. So your max loss is whatever strike price that was minus the money that went into your pocket. That's your max loss, but as you can see on the next bullet there, by definition that's less risk to the individual who bought the stock at retail. Warren Buffett has made billions of dollars with this simple strategy. Money managers and investors are not, the ones that deploy this are smart. They're doing exactly what I'm explaining to you today. So why not join them to do the exact same thing. So it's a win-win. The money's in your pocket, or you own a stock at a discount. This is just a diagram to show you the difference of the edge that you have in selling puts. As mentioned, if you're bullish on stocks, it's a one-to-one relationship. You have to buy it. Put your stop in, and you either win or lose on if the stock goes up or down. Same with shorting. So on the left side here, shorting a put versus long the stock. If the stock goes higher, I win. I keep my 100% premium. If it goes sideways, I win. The stock trader is frustrated. His investment has gone nowhere, so he's just tied up capital and that's it. If the stock goes down within my break-even point, which I'll show you, I still win. The stock buyer would have a loss. And then depending on how much it went down, if it goes below my break-even, well, then I've lost money also, but I now own my underlying asset at a profit. Here's an example we gave to our subscribers. This was a fertilizer stock. We were bullish on the industry. Weekly chart here. Remember the atom I went over, stage 1, 2, 3, 4. So this was a stage 4. It's now, in our opinion, at this time, was basing on a stage 1. We had a nice pattern there with a bullish wide range bar, multi-week consolidation. To us, this is a very compelling bottoming pattern. So we look at our option table and you determine which strike price you are comfortable with, either the risk or probability of it not going there, because remember, in selling puts, unless you genuinely want to own the stock at a cheaper price, we pretty much sell the put strike price below support because we want 90% probability of them expiring worthless. So I have circled here the 22.5 put, which is way under the current price of 27.29. So let's go through the math here. The bid is 42 cents. That's 42 cents a share. So if you sell a 10 lot, $420 will immediately go into your brokerage account. So that 42 cents divided by, and this is just it's actually much higher than this, but I'm just dividing it by the strike price, even though it would really only be 20% of that. So the return is really 18% on margin. But the important part is you have a 21% cushion, if you will, to break even, which is that 22.5 strike price less the money you put in your pocket, $420. So as long as this stock closes above $22.08, then you make 100% of this premium. That, ladies and gentlemen, is what we refer to as our paycheck. One of my favorite trading books is Jesse Livermore, Reminiscence of a Stock Market, and he says, wait, when you trade, wait until the odds are overwhelmingly in your favor, where it appears that there's a pile of money in the corner, and you just go over and pick it up. Greg and I find trades like this every single day that are high probability trades. This was another one, Mulsanne. For those of you that know technical analysis, this massive breakdown bar in mid-July on huge volume snapped right back into the consolidation. We call that a shakeout. And then when it started breaking out I looked at the very high premiums of selling out of the money puts, and even though I said you could do them under support, which would be $90, I went down another $10. Look at the $80 strike. I sold the 80s, the 77.5s, the 75s, and I was just collecting all of this money, and it's a massive 46% return with the stock being 30% away. That is my cushion, and I still make 100% of the profit. So I call this, it's just a no-brainer short put play. One more example here. Dollar General, the retails have been beat up. So we trade them on the way down as a stage 4, and we buy puts on them. But then we sit back day by day. We just wait for them to bottom. This is a massive multi-month bottom in Dollar General. Once I get a wide range bar that closed above the breakout, this is another no-brainer put selling candidate for us. So we went under support. We sold the 67.5 puts for $1.30 a share. That represents on margin almost 19% ROI for 37 days. And I have a 5.5% cushion. My stop, though, would be under support. So I don't want to own Dollar General as an investment, so I'm just a trader. So I would stop out of this trade if the very high odds compelling pattern here broke for some reason. It didn't. Now I'm going to show you something very simple called a credit spread, which is we just went over selling a naked put. A bull put spread is you sell you're going to put it on as a spread, but what it entails is selling that strike price that we just reviewed together and then purchasing a lower strike price as insurance, if you will. So then the benefits of that is it becomes a defined risk trade, so you know that your maximum loss is not the stock going to zero, which might frighten some people, but your maximum loss then becomes the difference in the strike price less the premium you took in. We have over 80% batting average with our methodology, timing them with the compelling chart patterns. And a bear call spread is the same thing, but you deploy them on the topping patterns. So that's the stage 3, and it's that chart I showed you earlier that said these are all bearish patterns. You would sell a call option above resistance, and then you would buy a call option a few strikes above for insurance. Same way, instead of a bull call spread, bear call spread. Let me show you a quick example, show you how to calculate the ROI, and we're getting close to wrapping up here. So spiders here, this is when they were trading at $220.58. So as the title of this slide says, let's do 2 short credit spreads, $1.50 wide, $2 out of the money, and that means cushion, if you will. All I'm doing when I sell credit spreads is I'm looking at the chart and saying, I don't think it's going above this number. So it can go sideways, it can go chop around, it can go the other direction. I don't care what you do, just don't go this direction. So I sell the 218.5, which is $2 higher than the strike price, and I just arbitrarily, for this example, went $1.50 strikes higher. I buy that option. What does that give me? It gives me a credit of $440. My max loss is the difference of these strikes, which is $1,500, minus the 440 that I put in my pocket the moment that I sold this spread. So my max loss on this bull put spread is $1,060. And that's only going to occur if the spiders fall below the lower strike of 217. So as long as it trades above the higher strike, 218.5, which is within my $2 cushion, I make 41% ROI on that max loss. It's just unbelievable. Hopefully many of you are salivating right now if you have not witnessed this before. But we do it every single day at MasterTrader. Greg and I were actually at the money show last week presenting and meeting some folks, and you know, Greg has his charts. I was trading in his car credit spreads on the way up there. At coffee breaks, Greg you know, finds awesome plays on his cell phone, and I put him in our letter that same night. I'm like, that's awesome. It was Travelers, TRV. Real quickly, the bear call spread. So I went $2 higher. I'm selling the 222.5. Then I'm buying the 224 as insurance. You can see the math here. I took in $580, 63% ROI on my risk for that bear call spread. I just pulled out some recent trades here. Every one of these are live that we gave to our subscribers, and we're not in for the home run trading, which means buying way out of the money calls or puts for cheap to try to make the home run return. That's more like you're playing the lottery. We don't do that, and that is a very unwise way to trade. 85% of options expire worthless. But we do take directional trades, as I mentioned. We're in Spiders, we're in some financials, we're in Morgan Stanley, we're in Regions Financial, and as I'm speaking with you today, the Spiders are making a new high, so those calls there are doing very well. So everything on this page right here, I have explained to you and we reviewed in just 40 minutes time. One thing I just want to show on this ESRX, we actually stopped out, meaning that the pattern went against us, but we still made $460. Why? Because of Theta time decay. When we had to buy back those naked puts to close them out, they were cheaper than they were the day I sold them for $910. That is the magic of trading options and selling options around the pattern. What can you do now? I told you I'm not going to give you a 15-minute sales pitch because that's not my style and we don't have the time anyway. Find a reputable broker. I trade off Thinkorswim, the platform owned by TD. Been doing it for a decade and I just love it. It works. My friend Tom Salasnos over at Tastyworks has a new BD. He has awesome everything. Interactive broker. I've heard good things about it. Make your first option trade. You get an account, set it up for option trading. Start slow, paper trade. You could do a covered call or short credit spread on one of the income trades. A bear call spread on the patterns I showed you, bull put spread on the patterns I showed you. Greg and I are just finishing up what we call here our all-inclusive advisory Market Edge membership. So it's this advisory letter that I've been talking about when I say we give trades to our subscribers. We give, we explain the pattern, we explain the trade, we give updates, lessons. We have a monthly live webinar. We have a private Facebook group that we post trades to all the time. premium videos. I'm finishing up a 9 or 10 part master option series. I hope I've done a good job in 40 minutes giving you a ton of interesting actionable option trading ideas. I promise you, if you take my 9 or 10 part series, you will be a new trading professional. There's some other things listed. We also do exactly what I'm explaining here to you for high net worth individuals. We work with a number of hedge funds to do everything we've been doing here together. We wrote I'm going to finish here with 2 gifts for you also. We wrote our end of year special report. It was $99, but this is mid-February, so we're going to give it to anybody interested for free. It's our broad market review, shows how we do sector analysis and stock analysis with our techno-fundamental approach to the market, and I've also done a more detailed covered call ebook. So if anybody would like to email me, you can sign up for these gifts, sign up for our letter, stay tuned for when we launch the advisory Market Edge membership. Email Greg also with any questions, equities, anything. And it's now 1 o'clock, and I promised I'd end on time, so thank you very much. Feel free to email me and wish you the best of trading success.